Hey folks, Bill Bodner here at the Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So here we are on a Thursday, and mortgage-backed securities and treasuries hitting the best levels since mid-February. And the theme of our weekly newsletter, which goes out to the partners and the realtors, is about less equals more for rates. And the yields are plummeting. And why? And giving stocks, stocks pause is because we're seeing less employment. We're seeing less inflation. We're seeing less economic growth, the threat of less economic growth. We're seeing less policy response from the administration, less policy response from the Fed. So all of this is giving reason for bonds to pop higher and drop rates again to the best level since February. And so as we head into next week, we have a lot of data, a lot of important stuff to be thinking about. We have CPI, which is the Fed's favorite gauge, not Fed's favorite gauge, but it's a consumer inflation reading. And what's interesting is this month, it'll be the second month in a row where the year-over-year CPI figure runs north of mortgage rates. So we were at 5%, it'll be about 5% year over year. Mortgage rates are probably under 3 this week, right? So that's clearly an unsustainable trend. But the other big thing that we're watching is the economic, or I should say the corporate earnings. So stocks start corporate earnings next week, and what they say about the economy going forward, or their forecast and their outlook and their earnings growth potential, could have a giant effect on what happens next for the financial markets, both rates as well as stocks. What I will leave you with is, while pricing got great, I mean, you can see here mortgage-backed securities have moved 100 basis points over the last month or so. This is material. When you see prices hit the 200-day moving average, this is where your clients, your real estate partners need to be aligned with a mortgage professional like yourself that's dialed in, understands what these levels mean, because this stopped the rally in mortgage-backed securities here on a Thursday, and the same situation happened on the 10-year note, stopping the 10-year note yield from moving even lower. So understanding what that means and sharing it with your clients will be very, very important, because things can't get any better unless the 200-day moving average is taken out. So I hope this finds you well. Have yourself a great weekend. Good times. See you then. Bye-bye.